Personal finance practice problem using OneNote. Present value of annuity using non-annuity Excel functions. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 1240 Present Value of Annuity using Non-Annuity Excel Functions tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, got the information up top, calculations on down below. We're looking at the present value type of calculations, present value of an annuity, noting that you can convert a present value of an annuity calculation to present value of one calculations, which one gives a nice comparison between what the present value calculations are and what the annuity calculations are, and two is quite applicable and practical when you're thinking about current practice. And if you're thinking about things that don't have even flows, then you can use a similar method in Excel. Note that as we take a look at these, tools such as Excel make these types of calculations much easier. And when we're thinking about more complex types of scenarios, we want to make sure that we understand that we can do these types of calculations in something like a spreadsheet program. Whereas if you're working these types of problems in a school setting using tables or something like that, then it's much more likely that we're going to want to try to group things into set chunks like annuity type of calculations. Whereas if we have flexibility of tables and functions, we're much more free to be able to kind of take things out and do more calculations of just the present value of one calculation, which can give us more detail in certain circumstances. So let's take a look at this. We got the amount of 1,000. We've got the rate of 7%. Years is going to be 5 years. Now, if we just look at the cash flow, that would be 1,000 times 5. We would be talking about 5,000 for the total cash flow. If we take the present value of the annuity, bringing that back then to time period 0, we should come up with something less than 5,000. That's going to be the 4,100. In other words, if we had 4,100 at time period 0, and we were to take out $1,000 for 5 periods, 5 years we'll assume here, and still receive a return of 7%, we would be able to do that with, instead of having 5,000, with only having the 4,100. The annuity calculation for that is equals negative, to flip the sign, present value of the rate, 7%, comma, number of periods, which would be the 5 periods, comma, and then the payment, which is going to be the 1,000 to give us that nice even amount. Now note, as we see this data, it's great if we have a nice even set of data here where we expect these payments to happen nice and evenly so that we can present value them in an annuity type of format. But we can imagine situations, for example, if you're doing a budget type of situation in the future, or if you're comparing your cash flow for a financial decision that you think you might be making in the future, then you can imagine situations where you don't think it's going to be an even series of payments that are going to happen in the future. You might do some kind of analysis to figure out how much you expect to receive on a year-by-year basis, in which case you can't really use the annuity formula. You would have to do a similar process using present value of one calculations. If you were to do that by hand, then oftentimes you would be saying, I would really like to kind of make estimates and whatnot to squeeze this into an annuity calculation, because doing present value of one calculations can be quite tedious. But if we do this in Excel, note, then it's a lot easier for us to do that. So it might even be useful for us, even if we have an annuity like this, to say, hey, I'd like to break this out on a 5-year basis and take a look at the present value for each period, even though I could plug it into an annuity formula. So this same calculation then we can see by plugging into a present value of one calculation. We won't do it mathematically because we would have to do it then, 5 times for the present value of 1, or use the tables to do it 5 times. But if we have it in Excel, then all we have to do is basically put in our table here, years 1 through 5, and then, now it's useful to have our table set up in this format in which we're going to lay out the years or periods on the left-hand side so we can use that in our calculation and be able to autofill or copy this down, making this a very easy thing to do in Excel. We do this in Excel if you want to take a look at it there. Then we're going to have our payments, which we're just going to list out the payments here from 1,000 each year, years 1 through 5, which of course would add up to the 5,000 simple cash flow. And then we could just present value each of the periods and see then adding up the present values. If we present value, in other words, each year, present value of 1 instead of present value of an annuity, and then we take the total of those present values, we should get to the same result as the annuity calculation of the 4,100. So for example, if we took this first item here, this 1,000, and say, okay, we're going to take that as a present value of 1 that happened 1 year out, present value it back to period 0, then present value of 1 calculation would be equal to negative in order to flip the sign. The rate is being pulled up here, the 7%. Notice it has an absolute reference, $ before the B and 4. You only need a mixed reference, but the point is that when I copy that down, I don't want this cell to move because it's outside of the table. I don't want it to move down relative as I copy this cell down. That's why it's got the $ signs. Then, comma, the number of periods. The number of periods is going to be not 5, because we're not talking about an annuity here, but 1. This is the first payment, which we're assuming happening 1 period out. You can see that that's being picked up with a reference, a cell reference, which is referring to this cell here, which only has a 1 in it. You could hard code or type into the formula a 1, but that'll make it more difficult to build your table, because when you copy it down, that hard coded or typed in 1 will need to be changed when you go from 1 to 2 and so on and so forth. Whereas if you build your table where you have one number over here that doesn't have anything else in it, like you don't want it to say year 1, because then it won't be able to pick up just 1. You just want a 1 in it. Then you can put that in your table, and that one will copy down. So when I do the same thing for the second one, that will change to year 2, and I can take the 1,000 discounted 2 years back. And then we have the comma. We have no payment because this is not an annuity calculation. We're doing present value of 1 5 times. So 2 commas to get to the future value, which is referring to that 1,000 here, which will then copy down as well when we copy the formula down. If I was to copy that formula down and do the same thing for the second one, you can see we come to a slightly smaller present value amount because the first one was present valuing 1 year back at a discount rate of 5% for the 1,000. The second one is discounting the 1,000, but now taking it back 2 periods, 2 years at the rate of the 7%. So notice we have the formula equals negative present value. The rate is the same cell, B4, referring to that 7% up top, comma, number of periods is now moved down. You can see cell went from G2 to G3, which is referring to now 2 periods. So 2 years, we're taking that 1,000 2 years back. And then we're going to say, comma, the payment is not used because this is not an annuity, but present value of 1. And then the future value is going to be that 1,000. That also moved down from cell H2 to H3, as it will do as we go through this calculation. And that gives us the 830.73. If we do the same process, just copy this cell down, discounting the 1,000 3 years out at the 7% discount rate, that would give us the 816. If we go 4 years out, we take that 1,000, discounting it 4 years out at the 7%, we're at the 763. And discounting the 1,000 5 years out at the 7%, we're at the 713. We get to that same end result if we sum up the 935, the 873, the 816, the 763, and the 713, giving us that 4,100. So this can give you an idea, notice, of the relationship between the annuity calculation, nice and simple up top, and then the present value of 1 calculations, which you can break this into a present value of 1 calculation. It's also useful to do this in practice because note now you can kind of see the present value on a year-by-year basis, which might be useful. And if you have any kind of deviation, if you're saying, hey, look, it's not going to be $1,000 even, I'm trying to figure out what my cash flow is going to be if I do a certain type of thing, I think my cash flows are going to be uneven during the year. It might be higher during the first part of the series of payments and less during the latter part. So you don't need to try to push that into a box so that you can do an annuity calculation. No, you just list out all your years and you just figure out your cash flow and you present value each year for a complex scenario, and that's no problem with Excel. It is a problem in a book problem where they take away a spreadsheet, but not really a problem if you have a spreadsheet program to do that, and highly, highly useful to be able to do that. You can also see that you might format your calculation in this format. Notice it's just a different way to set up the table. You want to get good at visualizing how to set up your tables, both in terms of what you think is best to set up the tables in and what other people think is best. Because if you go work for somebody else, or if you're trying to present to somebody else, the goal isn't to make it make sense to you. The goal is to make it make sense to them, or try to understand what they are saying. If they format the table differently, then that you want to be at the point where you can say, that's fine, whatever works for you, right? We could figure it out. So you can do the same table up top, years up top, 1, 2, 3, 5, and then you can figure out your cash flow. This often works. This format often works because if you're projecting into the future for something like a budget, you might put together a whole income statement for years 1, 2, 3, 4, 5, or a cash flow statement to get to your bottom line cash flows that you are expecting to be happening for years 1 through 5. And it might look something like this, right? You got revenue or cash inflow minus the cash outflow gives us your net cash payments. And then you might apply your present value calculations in the same format, but now, in a horizontal format on down below, which would look something like this. Same calculations. Present value now is down here. Present value, we're going to take the rate, which would be the 7%. It's also absolute referenced. You only need a mixed reference, but that absolute reference works, meaning when I copy the cell to the right now, it's not going to move that 7% to the right along with it, but keep it where it's at. And then we've got comma, number of periods is now 1, which is referring to this one. So same concept. I want just a 1 in that cell, so I can then copy it over instead of having to hard code or type in 1 to this cell, which means that if I did so, I would have to type a 2 here, a 3 here, and a 4 here. I'd like to refer to 1, 2, 3, 4 in the table so I can easily copy it over. And then comma, we've got the payment, which is no payment, 2 commas, because this is not a present value of annuity, but present value of 1. And then we're picking up the future value, which is that 1,000, discounting it back 1 year at 7% to 935. If we copy this cell to the right, you can see this will be equal to the present value of the rate, which stayed the same because we made it an absolute reference referring to that 7%, comma, number of periods now moved from L1 to M1, which would represent this 2, moving from this cell to this cell, comma, no payment, so 2 commas there, and the future value is now in M2, which is that 1,000 right here, which moved from here to here, discounting the 1,000 back 2 years, giving us 873. If we do the same thing, copying it over, discounting the 1,000 3 years out, 7% back 3 years, 816, discounting the 1,000 4 years back at the 7%, 763, discounting the 1,000 5 years back at the 7%, 713, adding that up, we get once again to the 4,100. Also, just realize when you set up these tables, because these are all the same, 1,000, you might just say, why do I even need that column? I could just pull that from this cell up here and make it an absolute reference, which you can do. But if it wasn't an annuity and these payments were different, which is often the case, if you were to apply this in practice and you want to do a similar scenario, then, and even if it's not, it's kind of nice to see that 1,000 here too, and just see that, okay, I'm discounting that cash flow down, and you can kind of see that comparison. I think that's a nice visual, and often the way, you'll see things set up, that's the way I would typically set them up.